I know from talking to hundreds of property investors every single year that there is a sense of overwhelm and confusion about all the different strategies out there and all of the different acronyms as well. And this confusion means that people often don't necessarily invest, or they are uncertain. There's doubts and fears around investing because they don't necessarily understand what they're getting into. So I wanted to go through some of the main strategies for property investing and explain the pros and cons of each so you can make better informed decision about how to move forward with your property investing this year. So number one is buy to let. Buy to let is probably the most straightforward and simplest strategy out there. A buy to let is the most common form of renting and involves one tenant or a family on a long-term contract with a landlord. And when people think of renting, this is the most common form of that setup and agreement. So what are the pros of buy to let? Well, firstly, it can offer some really strong yields and strong returns depending on the area. So in the north, for example, you can get yields of 7% plus. It is the lowest risk and the easiest strategy for any investor, whether you're new or experienced, to undertake, because it involves a flat or an apartment let out to someone on a long-term basis. So that's why it's often called vanilla, because it is straightforward, low risk and simple. And this simplicity comes from the fact that you're letting it out on a longer term basis. So you've got regular and stable amount of rental income every month. You're also not having to worry about like turnover of tenants compared to other strategies like short-term rental and HMO. And because of this simplicity, there is people out there that do manage the properties themselves because they feel that, well, it's only, one tenant or one family that they have to deal with. I wouldn't necessarily advise that because there is some complexity around the legislation around lettings, and that is actually getting more complicated. So I would actually advise using a letting agent and a professional. But compared to the other strategies, it is more simple to look after and to manage. Other benefits of buy-to-let are that you can obtain a mortgage on a property more easily. There's lower capital investment needed. So for example, you could get buy-to-let in the Northeast for £75,000. So you've put down 25% deposit. So, you're looking at under £20,000 all in for the whole thing, including stamp duty and fees. And the last point is that it's a future-proof strategy. We know that the rental market won't go anywhere. There will be some changes in legislation over the next few years, as there always is. But buy-to-let isn't going anywhere. There will always be a demand for rental properties, and there will always be landlords willing to supply those properties. So the government isn't going to change that, isn't going to ban it. It means that you can invest with confidence that it's going to be here for the long term. So some of the risks of buy-to-let are the fact that it is lower cash flow and returns compared to other strategies, for example, like HMO, because for example, in a buy-to-let in the Northeast, you will get around, depending on your interest rate, around £200 a month. And some people obviously want more cash flow from their investment, so they might look towards HMO or short-term rental. You've got the risk of void periods. If you're purchased a property in the wrong area or the wrong property itself, it may discourage people from renting. So you may firstly put off the tenant that was in there in the first place and they want to move out, and then you can't get another tenant in because of whatever the problem is, whether it's a sort of rougher area or an area where there isn't much tenant demand, or the property itself is in a poor condition. So there's some risks of void periods, and then obviously not getting the income from that property, and then you're going to have a problem about covering your mortgage. And the last point is that you've got a dependency on one tenant and one income source. Because you've only got one tenant in, you've got a risk of them not paying, or problems with that tenant, or void periods, as I've already mentioned. And that's different to HMO, for example, when you've got multiple tenants, and that means your dependency is across multiple people rather than on just one person. So next is HMO. So HMO stands for House of Multiple Occupancy, which means that you have a shared house setup with 3 or more people that are unrelated living in a house. So it is not a family setup. setup, tends to be friends, professionals or acquaintances living together in a shared house. These properties tend to be 3 or more people in a property, and they are most common with young professionals or students. That's the kind of common setup for a HMO. And the HMO setup means that you're charging per room. For example, if you have a 5-bed property, you might charge, depending on where you are in the country, £600 per room, which means that you'd be getting a income of £3,000 per month. However, the normal setup is that the landlord pays for all of the bills, so that includes utilities, broadband, council tax. So all those bills are included in the payment from the tenant. So say if your bills are £800 and you're making £3,000, that means your profit might be £2,200 per month. So HMOs have a lot more cash flow potential per month, but because of the nature of them being shared houses, they're normally large houses with a number of different bedrooms. There is a lot more legislation around them. You will need a license to operate one, and you need to comply with quite strict fire regulations, and that costs quite a lot of money to often implement those fire regulations, such as fire doors, smoke alarms, ensuring you've got a 30-minute corridor to allow people to escape the property in the event of fire. So these properties generally cost more to purchase and more to refurb. In terms of pros for HMO, you've got higher cash flow compared to, say, buy-to-let. You are less impacted by rental voids, so it's very unlikely you're going to get a whole property that's unoccupied, that's not going to have any tenants in it. So even if you've got one room that's voided, you're still going to be able to cover your mortgage costs and all of the bills from the payments from the other tenants, unlike buy-to-let. And then you've got, in a similar way, you're less affected by rental arrears, because it's again very unlikely that if you've got 4 tenants in a HMO that all of them are going to be in arrears. If you've got 1 tenant in arrears, you've still got income from 3 of those tenants, and that's compared to buy-to-let, when if you've got arrears and someone not paying, then your whole income from that property is affected. So the cons and the risks of HMO, as already mentioned, you've got more stricter legislation, which involves a lot more costs to implement and a lot more complexity. And that's compared to buy-to-let, when there's far less legislation around fire, for example, and therefore the refurb costs and there's no license required. The management side is a lot more costly and time consuming, because you're dealing with multiple tenants, and often there is a turnover of tenants, people coming and going. You know, you've obviously got a lot more queries because there's a lot more people involved. Sometimes there's conflicts and problems between the tenants. That can be quite a big one. So it is a lot more sort of time involved and an effort involved in that management. And that's why you should always use a management company for HMOs, because it is a lot more time consuming compared to managing one buy-to-let. And from a lending point of view, it is actually harder to get a mortgage on a HMO, particularly if you're a new landlord, and the mortgage costs are a lot higher as well. And HMOs don't work in every area. There's a lot more possibility of having a buy-to-let pretty much anywhere in the country, but HMOs will only work in certain areas, particularly where there are employment opportunities, where there are universities, for example, and that means that those areas could all be saturated from having other HMOs there, and you might be quite late to the party. So that's a kind of key difference compared to buy-to-let, is that there will always be demand for buy-to-let, but with HMO there will always be kind of saturation point where actually your supply might actually outstrip the demand, and that will affect your void periods and your occupancy levels for your HMO. So next is short-term rentals. What do I mean by short-term rentals? Well, this is where you let a property on a short-term basis to someone or a group of people. So that is potentially on over a few days, or for a month, for example. So this is people mean by Airbnb properties. Airbnb is one of the main platforms that people list their property on, and this is also what we mean by serviced accommodation. So serviced accommodation is essentially like a hotel but ran by an individual or a company, so you can stay in that property but everything is there available to you. And holiday lets is also an example of short-term rental, and the key difference between a holiday let and a serviced accommodation property is that a holiday let is often located in a tourist area, so for example Cornwall or the Lake District, where you're going to get seasonality because people want to visit during certain periods of the year, which means your income and your occupancy levels are going to fluctuate quite significantly, because you're going to get the big peaks during the summer months when you can charge a lot of money, and you're going to get the low season where there's less demand and you're going to have to charge a lot less. So that's the holiday let. And compared to that, to serviced accommodation properties are often city centre based or town centre based, where you've got demand more all year round. There is less seasonality. There is some seasonality, but far less compared to holiday let. And the serviced accommodation market is catering for all kind of visitors to an area. So that's whether that's people visiting their family, whether that's people traveling for work, whether that's contractors working at a local construction site or big project. It encapsulates any kind of visitors to an area rather than tourists for a holiday let. So in terms of the pros of short-term rental, you've got higher cash flow and higher returns for this strategy, but I would caveat that it needs to be in the right area and with the right property. This strategy also allows people to potentially rent out their own home, or a room within their home. So there's some flexibility there. And conversely, people can use these properties for their own holiday home. So that's quite a common thing that you get. People own a property in Wales or the Lake District, and they use it as a summer home or a summer base, but then rent it out on a short-term basis for the rest of the year. And SA, as I already mentioned, works in many towns and cities. So that means you get the benefits of a high cash flowing property, as well as a property that should get good capital growth over time. Another pro is that compared to HMO, you can switch your SA property or holiday let property, depending on the area, to a buy to let. HMO, you couldn't do that because HMO, it might have 6 bedrooms and 6 en suites, for example, and it's a large property, and that just doesn't really work for a buy to let. But SA and holiday lets offer that flexibility to switch to a buy to let in the future if, for example, the market changes. In terms of risks and cons of short-term rentals, you've got that seasonal fluctuations. So you need to view short-term rentals through a 12-month viewpoint and take an average across those, rather than thinking that that $2,000 profit that you're making in August is going to be carried out throughout the year and you're going to make $2,000 consistently every month, because you're not. And the same with a loss. You're not going to make a loss every month. It really does even out, and taking that average is the key thing. I always say that actually running a short-term rental is comparable to running a hotel. So that means there is a lot more administrative work and a lot more complexity around the management, because you've got guest communication, you've got linen to think about, and you've got cleaning. So there's a lot of turnover of people throughout the month. So for example, you might have sort of 20 changeovers throughout a whole month. So that's 20 guests to look at, that's 20 cleans, that's 20 sets of linen to change and to clean. So there is a lot of complexity around it, and you need to have systems and processes in it to ensure that you're not getting overwhelmed by those changeovers and you're not getting guest complaints. Lastly, in terms of lending, again, there is less lending options for holiday lets and serviced accommodation. That is kind of changing. Lenders are becoming more open to it, but there is still less lending options, particularly for properties costing less than £100,000, and the interest rates are a lot higher compared to buy-to-let as well, by normally 1 or 2%. So next, you've got flips. So a flip is where you buy a property, potentially do some work on it, and then sell it for a higher price, making a profit. And that's normally over a short period of time. So a flip generally tends to take place within a 12-month period. So you buy it, do some work on it, and then sell it, and all of that's completed within 12 months as a maximum. Some people can do it a lot quicker, within 6 months. But there's also some cases out there where you can buy a property, not do anything to it, and then sell it. That's kind of called property trading, but that is type of flipping as well. And you often see that people doing that at auction. And flip strategy is also used for people on a residential basis as well. So what are the pros of flips? Well, firstly, so it's about getting chunky amounts of capital in a short space of time. So I'd say the minimum you would want to aim for on a flip to not have any kind of problems and give you an amount of slack is about 15 to 20K. And then often people will use flips to build up their pot of cash to then be able to invest in assets that they keep on a later date. Often people use flips to gain experience, so get into property investing by doing a flip. I suppose as a side note and a bit of a caveat here, I would say is quite a risky strategy to gain experience because you're putting a lot on the line, and as I've done a video before on, you know, when we actually lost money on a flip ourselves, that actually if you don't get it right, it actually can burn you quite considerably. You know, in that example, we lost 20K. I think there's other ways and better ways of getting experience, but some people do use it to gain experience and some people do the work themselves, which gives them a lot more experience too, to be that hands-on. Of course, because there's no tenants, there's no management or maintenance to worry about. So that reduces the kind of complexity there because you're just going to sell the property as soon as it's ready. And similarly to gaining experience, it can be a really good way of building your network because you have to work with a full range of professionals, from solicitors to brokers to agents to builders. So it is a good way of growing those relationships, in some ways testing some of those people out. But again, there's risks involved in testing people out on a project where you might have 20 grand on the line. Cons and risks. Well, as I've already mentioned, there is higher risk here because you're putting all of your capital on the line. In my experience, flip deals, especially these days, the fact that refurb costs have gone up, have far less margin than they used to have. The minimum you want to aim for, as I mentioned, is 15K, but you know, it's very easy to lose 15K in a refurb that overruns, and particularly if you've got finance costs as well. And there is a higher risk here as well of unanticipated expenses. It might be that you underestimate the refurb. It might be that problems come up in the refurb that you weren't expecting. That means you overrun on the budget and potentially on the time. It could be that you are too optimistic, or the people that you've had to value the property have been too optimistic on the sale price. It could also be that the market changes over the time that you bought the property. So the market could crash, for example, or demand for purchases could reduce, or you get a completely unprecedented event like COVID, where the kind of all that uncertainty means that it's far more difficult to sell a property. So all those can affect your forecast for your profit and your costs. You also have to factor in the tax situation here and the additional fees because you're buying and selling the property in a short space of time. And depending on how you buy the property, there could be, for example, capital gains tax to pay. And also you've got additional fees on the selling side because you have to pay an agent to sell it. And because of the higher amounts of capital needed, because you're going to need to buy the property in cash, there is going to be finance fees associated with that. So whether you borrow the money from a private investor or through bridging, there is going to be fees and finance costs associated with that as well. And I think generally programs like Homes Under the Hammer make flips seem really easy, and in my experience they're really not, and there's a lot more kind of risk and complexity to them compared to what you see on the TV. Another con to flips as well is that you lose out on the long-term benefits of owning a property and holding a property. And as I have said many times on this channel, property is all about the long term, and the benefits of it are those long-term gains in capital appreciation and compounding, and you lose out on flips through that compared to the other strategies where you hold properties for the longer term. Guys, please hit the like and subscribe button today if you're enjoying this video. I'd really appreciate your support. Thank you. Next strategy is rent to rent. And rent to rent is one of those kind of horrible acronyms you see, and it's normally R to R. Essentially what this means is that you are leasing the property from the owner of the property, and then you're taking ownership of that property and then running it normally as a HMO or as a short-term rental property. So it is also referred to as kind of property arbitrage because you're renting it at market rate. So often you're paying the buy-to-let rate or slightly below it, and then you're paying that for the length of the lease. So normally 3 years. You're guaranteeing that landlord their rent for a 3-year period, and there's no voids from their point of view. Sometimes you might pay for the maintenance or contribute to the maintenance, and there's no management fee as well. So from their side, it's a really great deal. And then from your side, you're getting access to that property and you've got a reasonable rent to cover, and you are renting that property out on a higher nightly rate or room basis. And that's when your margin comes in, and that's where the arbitrage factor comes in, and that's you're making your profit. So for example, in terms of numbers, you might rent the property for £700 from the landlord, and then you might turn it into a 4-bed HMO property and you might get £500 per room. So you're getting £2,000 a month gross, and then you're taking the rent and other costs, including bills, out of that, and then your profit is what's left over. So the pros of rent to rent is the fact that you can get access to a property and make higher cash flow in a short space of time with very little capital input. You still need to pay for the furniture, for example, and depending on your agreement, you might need to do some minor refurbs. So a lot of the time you might give the property a paint as a minimum, and sometimes there is other costs associated with it. So some landlords might demand a few months rent up front as a security for them. So there is some capital to pay, but it is less than buying a property itself. So you've got higher returns and higher cash flow as well for relatively little capital expenditure. And you've got a lot more flexibility as well compared to purchasing a property, because you're signing a lease for a 3-year term, but that lease will often have a break clause of a year. So if that property doesn't work, then you can essentially hand it back to the landlord and kind of wipe your hands with it. If you're new to a property and you don't have any experience, and if you're going through an agent, they will often demand that you pay 3 to 6 months rent up front plus a deposit, which can be quite costly. And contrary to a lot of the people on social media who talk about rent to rent, you do actually need some capital for the furniture, the refurb, the rent and the deposit, as I've already mentioned. So it's not as easy and as small capital required as some people make out. The last point here is that, as I mentioned, and similar to flips, you don't get the benefits of owning that property. You don't own the asset, so you lose out on the long-term compounding and growth of that property, which is where the real wins in property can be. But as a beginner, it can give you a really good way of getting onto the ladder and building up some cash in order to invest elsewhere. So I also wanted to talk about more advanced strategies. I'm not going to go into detail about them, but I just wanted to acknowledge that they exist. So the first one being commercial conversion. So this is where you're taking a commercial unit, so for example a shop or an office, and converting that into a rental property and a home. This is a more advanced strategy because you need knowledge of planning and of building regulations and of architecture and of construction projects and more complex building projects. You can get great deals here because you're taking a property that isn't valued as a home and a rental property, and then converting it into something that is, and that's where you're getting the margin from and getting the benefit, I suppose, of doing that work. But it is, more complex and more advanced because of those factors that I've mentioned. And secondly, you've got title splitting, and this is where you're taking one title, so one property, and splitting it into 2 or more units and titles. So for example, taking a house and converting it into a number of flats, or you're taking a property with a garden and then building on the garden, for example, and then splitting that into 2 houses and maybe selling one or refinancing it. The third one, new builds and build to rent. So that's where you're taking a parcel of land and building a property or number of properties from scratch. And this is definitely the most advanced strategy because you're starting from nothing and building from the ground up, and there's so many things that can go wrong, and there's so many kind of factors to be considered here, and the stakes are a lot higher because your budgets are higher, potentially in the millions for build costs. So it's higher risk, and therefore you really need to know what you're doing. So that's an overview of all of the main property strategies, and you may be sitting here now thinking, well, how do I actually make a decision about which property strategy to go for? Well, that really depends on a number of factors that you need to consider that will then help you to make the best choice. So firstly, what are your goals? Whether that's short-term legacy creation or whether that's short-term cash flow, for example. Secondly, how much capital have you got? That's a big factor, and that will rule out a lot of these strategies if you haven't got some capital. Thirdly, how much time have you got? Some of these, as I've already mentioned, are time consuming, particularly on the kind of management side. Fourth, how much knowledge and experience have you got? As I said, some of these strategies, for example, buy to let, are more on the simple side, and HMO is on the more kind of complex side. So you've got to factor in your knowledge and experience about where you sit and what you're comfortable with, but also, there is lending restrictions as well, depending on the amount of experience you have. And lastly is your risk tolerance. As I mentioned, some of these are a lot higher risk than others, and you've got to decide how much risk you're willing to take on and how comfortable you are with risk. So think about all those elements. I have done another video on essentially goal setting and starting out in property and helping you to kind of make a decision. So do go and check that video out and consider all of those elements when thinking about which property investment strategy is right for you. So good luck. Thanks so much for watching till the end of this video. If you could do me a massive favor, which is to like the video and to subscribe, it really does make a difference to us. And it's the first metric we always look at. So I'd appreciate your support, because it will just help us and encourage us to continue making content like this for people like you. So thank you in advance.